started talking about the economics calendar. Now, the economics calendar is a tool for traders. It falls in the category called fundamental analysis, but it's one of the great tools that we can use because it's one of the tools that we have to predict what is going to happen or what's going to affect, not what's going to happen, but what's going to affect the markets. And we can know this in advance. So it's one of the few tools that tell you on such and such a day at such and such a time, we're going to have such and such an event. Well, when you know that, you can start doing your calculations ahead of time, or you can spend the weekend before getting everything prepared for what or how you might trade when that event takes place. But whether you're going to trade from the economics calendar or not, you should never, ever enter a position without knowing and looking at the calendar. Because you could be completely right with all your analysis tools, all your systems, all your strategies, and you could determine you're going to buy the euro against the dollar to go up, or you're buying it, and you expect it to go up 20 pips, 30 pips, 40 pips, whatever it is, and you could be completely right. At the end of the day, it could end up exactly where you said it was going to be, except because you didn't look at the calendar. You didn't see at 1 o'clock Mario Draghi was going to make a speech. And his speeches alone at any time cause market volatility and could cause that euro to swing up and down, up and down, up and down. And you could have gotten yourself stopped out of a perfectly good trade only because you weren't aware that something might cause extreme volatility during the day. Or you might have been able to close your position at bigger profit if you were aware that he was going to cause this volatility. But knowing that there might be that market volatility, maybe you wanted to close your position right before he spoke. Whatever, you still need to know these events, and it's very rare that you can do that. Now, tonight's class, we're going to focus a little bit on a big event coming up this week, which is the non-farms payroll report. Okay. Now, we're not going to analyze it and dig through it because I haven't done any research on it at this point. But we're going to look at how we would use this or how we could build a matrix to decide what we might want to do on Friday. But before we can get there, we have to understand how to read this calendar. And the calendar is very, very important, whether you're going to trade from it or not. It's not a very complicated tool, but you have to understand some of the information. So I'm going to take you over to a calendar from investing.com and also one from FX Street tonight, and I'm just waiting for it to pop up on your screen. Now we're looking at the calendar from FX Street. Okay, it's not complicated, but the first thing you should always do when you're going to use a calendar, and you shouldn't jump from calendar to calendar. Just find one calendar you like, and there's the calendars available on our website. There's calendars available from just about every news site. But once you find the one you like, set up the calendar and use it correctly and go back to the same one all the time so you don't have to keep setting up your settings. And if you notice here, I've got an account, free account, but it means every time I come back and log in, it doesn't cost anything. Every time I come back and log in, I'm going to get my calendar set with my settings. Okay. Now, the first thing we need to do whenever we're going to use a calendar is to set up our home time. It's crucially important because you don't want to make a mistake because you calculated the wrong time, or you thought the payroll report was at 1:30, but you didn't realize we flipped from BST to GMT time right now, and you calculated it incorrectly. So simply set it to your home time zone. That's not very complicated, but it's something traders overlook all the time. Same thing when you're using charts. Always make sure your charts are on your home time zone. Okay, I've seen guys use charts and charts and charts, and they don't realize that those charts, yes, the price of the asset is the price of the asset right now, but they don't look at when they look at the timeline on the bottom of the chart that it's giving them, they got to set up a New York time, or they have it set up in Asia time or Australia time, and they don't realize Yeah, they're seeing the price of the asset, but when they go down and see what it was like 3 hours ago or yesterday, or at 1 o'clock today, they're seeing 1 o'clock in the U.S. Set the time zone all the time. Now, once you set your time zone, you need to go and understand that there's lots of filters. Now, we're going to talk about these this evening, and we're going to go through them pretty quickly, though. The most important filter is the countries. If you were to leave all the countries involved in an economics calendar, you would have so much data you would get lost. Now, there's something important to remember. This economics data is released by statistical agencies or government agencies. It wasn't created for the Forex or the financial or the CFD markets. It's all the statistical information governments release. Now, that piece of information or that report could be critically important to you if you were in a specific industry. If you were, say, home healthcare workers, or you'd want to look and see what the employment is for home healthcare workers. We don't care in the financial market, but you have to understand that these reports cover everything and anything. Now, the first thing that the calendars do is they sort out all the irrelevant reports that are released by governments and agencies that have nothing to do with the finance market. After that, we've also sorted out the financial or the economics calendar, also sorts out most of the countries we don't need to deal with. Okay. Now, if you're dealing with some South American currency, you might want to see what events are in Argentina, Bolivia, Peru. Okay. But the fact is, on ETX, we can't even trade those. And in most cases, we're trading whether it's currencies or stocks or commodities that are affected by the major economic countries throughout the world. So we can look at this calendar right now and we know we can go down. We don't need Argentina. Okay, since we trade the Australian dollar a lot, we want Australia. We don't need Austria or Belgium. Brazil, Canada, if you trade the Canadian loonie, or if you watch oil and gas. Chile, we don't need. China, of course we need. Of course, we need the EU. We don't need Finland. We don't really need France. We need Germany, because Germany is the biggest economy in the EU, and its economics data will have an effect on the euro. France on the whole, France, Spain, Italy, their independent economics data doesn't really affect the euro. Greece, we're not looking at. Hong Kong's not important to us. Hungary. Now, if you're trading something from there, or you're trading a particular stock that might have big exports there or something, you might want to be aware of it. Okay, but you have to determine on your own. Japan, we're always aware of. Japan, because we always have the Japanese yen, which is a safe haven currency. Mexico, the Netherlands, New Zealand, if you trade the Kiwi or you trade a commodity currencies. Okay. Spain, United Kingdom, we don't need the Swiss franc unless you're trading the Swissy. Don't need the Turkish lira. And of course, we need the United Kingdom and the US. Okay. Because we have to make this calendar workable for us. We can't get inundated with irrelevant data because we'll get lost in the calendar. Okay. Now, under categories, these are the categories of the events. Okay. Almost all of these we need. And below that, we get something that's called volatility. Now, volatility sometimes is called importance. Some places call it impact. Some use it. They have all different terms. Okay. It's all the same, and it's broken into 3 levels because there's what we call top tier, second tier, and third tier data. Top tier is the most important data. And all economics data is broken into these tiers. The gray one here, or in some cases it's just nothing, are events that aren't economics. It may be the G20 summit. It may be a speech by Donald Trump. It might be something that has some effect on the financial markets, but it's not something that can be rated. Okay. So these are the levels. The red level in this case, now all of this data comes from feeds from the releasing agencies. Now these feeds can only be sorted so much. So all the economics calendars try to be creative and use slightly different colorings, different layouts. But the fact is, the piece of data that comes out and the feed that comes out tells it's in a level 3 data. In this case, that their computer system or their developer tells it level 3, give it a red. If we go over to investing.com, they use bullheads and they put level 3 with 3 bullheads. Okay. It's still the same thing. They all just have certain things they can do because the feeds come in, they're fed straight in. And so there's only so much information or so much that they can jury or jig around to make it creative. Because that's the nice thing about the economics calendar. It's straight data. There's nothing analytic about it. There's nobody who's put their own spin on it. There's no analysis that goes to it. It's straight numeric values that have been released by the releasing agencies that come directly to you. And they come to you just about as fast as they come to hedge funds, as they come to, to big, private investors, to central banks. Everybody gets it just as fast. Now, we need, like I said, we want to bring this calendar down to a workable place. Now, level 1 data, in this case it's yellow, isn't data that's important enough to the financial markets that will actually move a currency or a stock or a commodity. So we don't really need to look at it. Okay, you should be aware of it, but we don't need to spend our time on it. Level 2 data, or in this case, the orange data, a lot of times is a sub-report of a much more important report. And we'll look at that when we look at Friday's non-farms payroll report. Or it's an independent report, but it's not a high-level report. Sometimes, due to economic situations and due to the market, how the markets are, and where the markets are currently, or what's important to the market today, or this in this time frame or this period, could have an effect on a currency or stock. It'll have more effect, say, on a stock. If some data is released about home building, maybe it might give a bump to all the retail, to all the builder stocks. Okay, not enough though that it will cause a tradable effect, but enough that you should be aware of it. And then level 3 data is the most important data to the marketplace. And it will most likely have an effect on commodities, currencies, and stocks. So in order to make this calendar manageable, we only want to look at level 2 and level 3 data, and to make our lives manageable. So as you see, when I reset it and use the filters, okay, today there was only a handful of events. These events are important enough that, and minimal enough that we could actually spend some time analyzing them. Now, if you notice today, we don't have many economic events. We have the RBA rate statement and interest rate decision, which is very important to the Australian dollar. We have PMI construction for the UK, which is an important report. Okay, Boris Johnson's speech is important, and it might have had an effect on the pound, but very, very little. He did. I think today he mostly attacked Theresa May and Brexit, but it's something that you should have been aware of today. It might have caused a little bit of static in the financial markets or in the FTSE. Then we have always Federal Reserve president's speeches are laid out there. Okay. Now, Fed's Quarles speech he's not an important, or she, whoever it is, isn't an important member of the Fed. But later we have Fed Powell, who's the head of the Fed, and you see his speech is a level 3, or the red level. But if you notice, once we've used our sorting tool, we've got this down to a sizable amount of data that we can deal with, and that we should be aware of. Now, before we can go on and talk about this data, we have to learn to read the rest of the calendar. So the first column is going to be the time of the release. Okay. We've already set it to our home time zone, and we're fine. From there, we're going to see the country and the currency that's going to be affected by that economic release. Now, it used to just say the currency, but as the Eurozone grew, we have the euro that's affected, and it could be German data. So if we go down here, we can see we have German data being released on this report. It's the euro, but it's Germany. So that becomes an important report for us. Now, after that, we get the name of the event. Now, after you use the calendar for a short while, you'll know what these events are inside and out. All the countries around the globe release the same kind of data, but it's called something slightly different in each country for some reason. So like the jobs report in Australia, it's called the jobs report. In the UK, it's called the claimant count. In the US, it's called the US non-farms report. There are reasons for all these different names, but they're all the jobs data, the jobs reports for those countries. And after a month cycle, because it's the same data every month or every week, and you'll get to know what they are by heart. So you don't need to rush through them. Now, the fact is, we've also, or the calendar's made it easy. Every calendar either has a link that you can open, or it'll have an information box or some type of information that you can easily access. So we're going to start out with the Eurogroup meeting here. We're going to click on it, and it opens it up, and it tells us exactly what this is going on. The Eurogroup meetings are attended by the Eurogroup president, the finance, whatever. And it will also give you the link directly to whoever's involved. So let's go from the Eurozone meeting, and let's go over to a piece of data. So here we have, down here at 8:30 today, or this morning, we got PMI construction. Well, that stands for, PMI stands for Purchasing Managers Index. And UK construction release is important. It's released by a company called Marquette, who releases it for almost all of Europe. Now, the PMI construction released by the Chartered Institute of Purchasing and Supply and Market Economics shows business conditions of the UK construction sector. And it explains to you PMI above 50s in expansion, PMI below 50s in contraction. And if you want to read the actual report, you can click on this link. And believe me, once you've read one of these reports, you'll never go back to them again, because they're a huge, boring statistical analysis. And most of it has nothing to do with this, because it breaks down every bit of statistical data from every segment in construction, because that data, like I said, it's not for the financial markets, it's for the government and for everybody who needs this information. So it might be crucially important to you if you're importing concrete and you need to know what kind of demand is and if demand is up. We don't need to know that for the financial markets. Also, if we scroll down, we can see a set of charts and information. This becomes very, very important, because we need to be able to see some information about how this report has come out over the past, whether it stayed near its forecast, whether it's been in an upward, steady upward move, does it jump up and down, where does it go, and what's the average report? You know, if you're looking at new housing starts out of New Zealand, would you have any idea what the average should be? Maybe it's 6,000 houses a month. Where in the US, it could be 600,000 houses per month. You know, in the US, they sell several million homes a year. I think 5 million, I think it is. That's off the top of my head. You know, it's a big difference. So you need these charts. Now, each calendar has different charts. Same data, different charts. I happen to like the data and the charts provided by FX Street. Because not only do we have actual deviation, we have true range, and we can pick the currency we're interested in, see the range and how it affected that currency. We can see the deviation impact, and here we see it on the Jan from that report. We can see it on the pound. We can see the volatility ratio and how it affected that particular asset when that report came out, and we can see if the report was good or bad and what the effect was. So these reports are crucially important. Now, again, the nice thing about the economics calendar is we have time in advance to do our analysis, which we normally don't have in the market since they're continually moving. So it means on Saturday or Sunday when you know the wife and kids are out for the day, you want to sit down for a couple hours and do some research and do some preparation. You have everything you need. So let's go over to one last part of reading this calendar that's crucially important. We move over to the right, and we see three important columns. And these columns actually move all the way from the right towards the center. Because the first thing we get is the previous. The previous is the data that was released at the prior release for this report the last time it was released. So for a minute, since PMI construction is a standard monthly report, let's stick with this for a minute. So the last time this report was released was released at 52.9. So that was a month ago. Construction PMI in the UK was 52.9. Now, about a week before the data is going to be released, we get, which is called the forecast or the consensus or the opinion. Now, all of this data is fed directly by feeds into the calendar, except for the consensus or the forecast. Because have you ever read in Bloomberg where it says our 240 analysts have predicted this report to come out here? Or we surveyed 200 economic specialists, and this is what we're expecting on that report. Because government agencies do not release estimates or consensus or forecasts. They report the data. So these data in the consensus line comes from different sources. And each calendar gets their source from somewhere, you know, whether it's Bloomberg, whether it's Thomson Reuters, wherever they're getting it from is where they get it for the consensus. But you'll notice they're pretty much the same, and they're fairly accurate and they're relied upon. Now, this is an important number to you because the markets adjust to the consensus. Okay? Because we know what it is before, and we've already shifted the price of the assets shift to what the markets are expecting. And then finally, when the report comes out, we get the actual piece of data. Now, if we see this data in red, it means the report was weak. It missed the expectation. So we were expecting 52.5 and we got was 52.1. If it was better than expected, it would be in green. That's just a piece of information for you. You're still going to look at the number and you see the consensus. You can draw your own conclusion. It's just lower or higher. Now, the other thing that happens when this report is released might happen here. Now, as I said, the previous report is the number that was released the last time this report was released. But because these are huge government statistical reports and data is constantly coming in and is constantly being analyzed and changed and updated and reconfigured, that if there was what we call a revision, that means that when all the statistical data was gathered over the next following month, they realized that the total was different than the actual release. They'll release what's called a revision when they release this piece of data. If there's a revision, you will see this number here in red or green. If it was revised upward, it'll show you what the revision upward was, and it'll show you in green. If it was revised downward, it will show you what that revision was in green, in red. Okay. Now I'm going to tell you a story, but first I'm going to take you back over to my PowerPoint, and we're going to tell you a story about your kids and their report cards to try to explain to you what these three columns are, because they're very, very important and how they would affect the markets. So imagine this economics data is a report card on a specific sector of the economy or on a particular student. Now you're sitting down to Sunday dinner and you say to your son, hey kiddo, report cards are due on Wednesday. How do you think you did? Well, he starts out and says, well, Mom and Dad, last semester I brought you home 4 C's and 4 C pluses. They said, yup, we remember. Now what is that? That's the previous. Now, remember, the fact is you didn't do any analysis. You didn't go talk to his teachers. You didn't talk to the principal. You didn't talk to the Board of Education. You didn't take a look at all the other people's grades. And this is just the numbers that he brought home, and you accepted them. Same thing with the economics report. You can analyze it. The markets can analyze it. Everybody can do all kinds of analysis, but it's the straight data. Now he says to you, well, I think I did a little bit better this semester. I think I'll bring you home maybe 4 B's and 4 C pluses. Okay, well, your mom and dad, you're really happy he's doing better than he did last semester. And you give him the good parents lecture about, if you want to get a scholarship to university, you better do a little bit better than that. A little bit less time on Facebook and a little bit more time studying might help you do a little bit better, but you did better than last semester, so we're proud of you, son. Now, you've now set your expectations because your son's very reliable. So this is now what you're expecting. And he walks in the door on Wednesday and he hands you the report card. He runs right out the back door to play soccer. You open up the envelope and it's all B's. You're thrilled to death. You open up the back door, you holler out the back door, hey kiddo, I'll take you to the mall, we can go to the food court and get dinner, and then we go to a sporting goods store and you can get whatever you want. Because you're ecstatic. Why? Because it's better than you expected. Now, if he would have told you on Sunday at dinner, he thought he got straight B's, well, you would have been happy on Sunday, and that's what you would have been expecting today. So your reaction wouldn't have been as strong. But because the actual was much better than the expectation, you had a very positive attitude, a very positive result or response. Now, by the time you finish out holler out the back door, start putting the stuff up from dinner so you can go to the mall, the soccer ball comes through the back window, busts the window, you have glass all over the floor, and you're pissed. You holler out the back door, I told you not to play by that side of the house. Get in here and clean up the glass. We're not going to the mall because I got to call the handyman now. and there goes your mall and your thing from the sporting goods store. This is exactly what happens in the markets. You can have a good report that can be very positive and help the asset 1 minute, and 2 minutes later, something else can be the exact opposite. So you have to be able to judge how strong this report was, how much the markets are going to react to this report. Will it be an instant reaction? Will it be, what point will it give you enough to be a positive reaction, to give you a tradable effect? Or what point will it be a good reaction, but it's going to be a long-term effect? You know, if the U.S. jobs report is a little bit better than expected, okay, it's not going to have that much of an effect on the markets, especially, you know, at a certain range. But it might strengthen the dollar over the long period, or it might be more positive on some stocks or the stock exchange. So figuring all this out is very important. And we do this by doing it in advance and building what we call a matrix that'll give us what we call market neutral, market negative, and market positive. Now, this is not very difficult, but it's a little bit involved. So we're going to look at Friday's non-farms payroll report. Only because I haven't done any research on this report, but we're going to do this real quickly together, and then you could do your own research. So let me pop it up on the actual calendar, although the screenshot is the actual calendar, but let me just share it with you on the live calendar. Okay, so we have it down here. If you notice, this U.S. jobs report has lots of reports. It's got lots of primary, what we call headline reports, and then secondary reports. But all of this can have an effect on the markets. Well, the first and most important reports are the ones in red. But the most important one is the first one. It's the non-farms payroll report for September. That's how many jobs were created in the U.S. last month. Okay, if we open the box, it will explain it to you right there. Now, we can only build the matrix around one report, although we have to factor in all the other reports. And the first thing we have to do is start out with what we would consider market neutral. So we have market positive, market negative, and market neutral. Market neutral would be a number around this 188, which is the expectation, that would not create a tradable effect in the marketplace. The markets would look at it and say, oh, it's a little bit better, a little bit worse. Okay. You have to determine this yourself by looking at those charts that I showed you before. Look at, see where the jobs report has been. Do a little bit of research. You'll find out the U.S. has to create, on the average, it's, I think, they have to create on the average 200,000 jobs a month or 600,000 jobs a quarter. Now, the U.S. government and the Federal Reserve, they don't care month to month. They're looking at quarter, 6 months, and annual. But the financial markets are responding immediately to the current report. But you have to be aware that maybe last month's was much better than expected. So this month's going to be a little bit lower, okay? Or how volatile it should be. So we know 188 is what the markets expect. So once we've done some analysis, we can assume that anything above we can say 198 and above would create a market positive. Anything below 198, okay, and then a fall, so we could say 178, I would say this is even wrong. we can say 193 to 183 is what we're going to call market neutral. Only saying that it's not going to cause any tradable effect on any assets. Okay? It's just neutral. Anything above 193 would create a positive environment. Anything below 183 would create a negative environment. But this is just where we're starting. The rest of this is what we call bumps. So the first thing we have to look for is revisions. Now, if we have a revision up, if we don't have any revision, we have to pay no attention to it. But if we have a positive revision, an upward revision to last month to the non-farm payroll report to the 201, okay, we can't analyze that number. Can't analyze its overall effect on the markets. So we call it a bump. So if this number here was better than expected, it could bump the range that the first report came out at. So say the first report came out at 192, in neutral, but there was an upward revision to the prior month. So that we could say bumped it up into market positive territory. If it was a downward revision, it wouldn't have marked it into negative territory because we were at 192. It would have marked it and left it in neutral. But then from there, we go to two important reports. And right now, we're spending more time looking at hourly wages because we have basically full employment in the US. Okay, once we're down below 5% unemployment, everybody that wants a job has a job. Now we're down at 3.9, so everybody's working. So the unemployment rate won't have much of an effect. Anything. So what we're looking at now is the average hours earnings. We want to see that the people that are employed are earning more money. Because see, a lot of people went back to work because jobs were created, but they didn't necessarily go back at a job paying what they had in their previous report. Or people on hourly wages weren't getting raises. So it's important to see that overall wages are climbing. So this report is important. So we're looking for a climb of 3%. Okay. Again, if this report comes in better than expected, it will bump this report up. Now we have to combine it with the other bumps and the other minuses. Okay. Then each of these reports, okay, unless they're a big miss or a big hit, unemployment is expected to drop down to 3.8%. But unemployment, if you did your research, can jump to 3.9 or to 4.0 and won't have any effect on the market because a lot of times it's a statistical anomaly. Okay. We know everybody's being hired. It's whether it's 5, whether it's 4.0, 3.9, 3.8. Okay, it's just a matter of statistics because everybody's working. So it won't have much of an effect on the overall market. So these are what we want to do and we also have to look at the revisions for all these reports. And so we want to take into account each bump up and down in every direction and keep bumping and banging, bumping and banging these as this report's all being released simultaneously to find out whether we have a tradable effect. Because like I said, this number could come out right here. Okay, so you say no, but then this revision could be revised upward, and this number could have come out better than expected, and all of a sudden you see a dollar rally and the S&P jump up, and you say, well, the jobs data came out right where it was expected. No, it didn't because you didn't take into account the bumps. So what you have to do is factor this all together. But again, by using these reports, spending your time ahead of time, because now you can adjust all these. But another thing you have to do is decide what assets will be affected by this report. Not all assets are affected by every economics report. Some economics reports might have no effect on the S&P and the Dow, but if it's a housing report, it might have a strong effect on Home Depot. If you're trading Home Depot stock, you're trading Walmart stock, retail sales misses slightly, okay? But not enough to make an effect, but it could have a big effect on Walmart and Target and Sears, the direct retailers. Okay. Could have an effect on the S&P, but having no effect at all on the dollar. One have an effect on gold and one have an effect on oil. Okay, so you have to figure out what assets will be affected. So again, this is down here. We can also see all of these reports. If we see the actual deviation, we can see here what the consensus was, what the actual was. So like last month, we had the consensus at 191, and it actually came in at 201. So it came in 10,000 jobs better than expected. Now, you can go back and look and see whether last month, if it had a positive effect on the dollar. And you have to put all this together. But the fact is, regardless of whether you're going to trade from the economics calendar, okay, whether you're going to trade the market volatility, and there's many strategies you can use. You can trade ahead. You can buy it ahead. A lot of times, like when there's the Federal Reserve or a big piece of data, you could buy the dollar now and close your position before the report ever came out. Or you could go open an OCO on the ETX platform, and that's one cancels the other, figure out where your support and resistance levels are, open up an OCO above and below the dollar or gold or whatever asset you're trading, and that means if the price, the report comes in positive and pushes the dollar up, it'll open the trade in the direction you selected and cancel the other one. It does the opposite. There's many ways you can trade this, because at ETX, and we're not looking at long-term trading. We are not long-term investors, we're traders. So we're looking for something that's going to create momentum. Okay. And you'd be surprised, using these reports can, especially the level 3 reports, can create tradable events for you that have high potential returns. But you have to learn how to use them. But you also need to be aware of them so that no matter what you're trading, you can prepare for the market to have some type of response. Or if you were trading early on Friday and you were trading something across the dollar, okay, a dollar across, regardless of what it is, maybe you say, before this report's released at 8:30 in the morning in the US time, I want to be out of the markets. Let me close my position sometime before that and take my profit so I don't get involved in the volatility. So there's many ways to use the economics calendar. And trading the news can be successful, but it can be high risk because it does create a lot of volatility. But there are some strategies out there that you can master. Like I said, for instance, taking a position before and getting out afterwards. I mean, immediately after, not trading the volatility. A good thing is when the Federal Reserve is meeting, you can see what it's going to, pushing gold down or gold up. You can trade earlier in the day to buy gold to go down if it's pushing it down, and right before the report comes out, get out of your gold because it's as low as it's probably going to get unless the report comes out negative. So there's ways to trade the market expectations. There's ways to trade the volatility of the markets, or there's also long-term opportunities. So thank you very much for joining us tonight. Thank you for supporting ETX, and we'll talk to you again real soon. Bye now.